Yeah, very good afternoon, everyone. I am Diwakar Yadav, Mutual Fund Product Manager from HDFC Securities. First of all, I would like to thank you, every participant, for taking out the time and joining this webinar. Today's topic for this webinar is like India Rising, a multi-decadal opportunity, wherein we are going to learn about favorable factors which will be part of growth story and one of our recommended scheme from Bandhan AMC. And to discuss that, today we have Mr. Rahul Agarwal with us. He has joined Bandhan AMC in 2023 as a vice president in equity fund management team. Currently, he is working as an analyst and stocks in the financial sectors. Prior to joining Bandhan AMC, Rahul worked with HSBC Mutual Fund as an investment analyst. Before that, he was a senior investment analyst at ICICI Prudential Life Insurance and was an associate analyst at Kopal Amba. Mr. Agarwal completed his PGDM from TA Pai Management Institute, Manipal, and has a BCom honors from Bhawanipur Education Society College, Kolkata. So welcome, Rahul. Over to you.
Yeah, thanks, Diwakar. Thanks. And welcome, everyone. So we'll be talking about India. I think it's a very exciting spot. And we'll try to, in the next 30 minutes or odd, I'll try to give you a sense of what kind of trends and the big picture that is happening in India, so to say, and that also in some way globally what is happening, which is impacting us as well. So just to give you an idea, जब भी आप थोड़ा सा लॉन्गर टर्म व्यू लेते हो, लॉन्गर टर्म सोचते हो, तो आप साइकिल्स में सोचते हो. तो साइकिल्स में क्या होती है कि लॉट ऑफ इकोनॉमीज गो अप, लॉट ऑफ इकोनॉमीज कम डाउन. At the same time, there are superpowers which emerge. So you have to think in those lines when we are talking about decadal opportunities, and that's what we are trying to do today. Also, we are trying to give you a sense of what today it is going to be. Just starting off to give you first the perspective of what India is today, as of today. So we are the fifth largest economy, and we have the second largest road network in the world. We are one of the fastest growing major economies out there. Our rail network is fourth largest, which is there. We have a forex reserves which is spanning $650 billion, which is quite a healthy amount. And in terms of our user base, internet user base also, we are second largest in the world. So standing as of today, that's the kind of positioning you have, and going ahead, it will be even better. Now coming to, there was a pivotal point in the India's economy journey in 1991, which was the liberalization during that time that happened. And when you compare us in this last 30 odd years, where we have reached, you will see that our GDP in that term has grown 10x. Our share in the world GDP has grown by 2.5x. GDP in even in the PPP terms has grown 10x. The per capita GDP, we would have wanted it to be more, but still we have grown 8x in this period. And so has our forex reserves. So forex reserves were one of the reasons why we had to do a lot of things we did back then. That has grown from 5.8 billion to now 600 billion plus. So that's the kind of journey we have seen in the last 30 odd years after liberalization. And also, if you see where we are growing now, within all the major economies, our growth rate has been the fastest, which is there. And our journey is just the start of it. We are poised to become the third largest economy by 2028, which is according to the even the conservative estimates, we are going to be achieving those kind of numbers. Now coming to the reasons why something like that would happen, and this is something which is very key to India. When you look at the demography that India has today, and you compare it globally, what is happening, we have one of the youngest populations in terms of median age, which is there compared to our peers. And when you look at the other countries going ahead 10 years later as well, we are going to enjoy this dividend in a big manner. Whereas countries like Japan, US, they are going to China, they are going to see a decline in their working age population, whereas India will be seeing an increase. And that is one of the biggest factors that is going to change and shape the next decade that is going to come. Now, any company, even I'm sure a lot of you are part of companies, and you would realize that when those companies grow, with it the employee force grows, the branch reach that grows. So unless you have a productive working population growing in a significant manner over 10 years, 20 years, 30 years, it will become a challenge because you start to peak out. In our case, given our median age and given the way demographic dividend is, for the next 30 odd years, we should not be worried about this aspect, and that's going to be a key driver for our decadal growth story going ahead. Now, coming to just giving you the broad idea about our path that is going to be there for the next decade, and to give you more confidence on why India's growth path will be so strong. Now, when you look at any economy and what are the things that are happening in it, which are shaping up for trends for the next 10 years, 20 years, you talk about macro stability, how the macros are of that country in terms of the balance sheet of that country, and also its deficits, trade accounts, how are those panning out? And that really gives you an idea about what the next decade is going to be. When you look at the government initiatives, which is a key for any emerging markets and developing market, government remains a very key element in the economy, which goes and pushes the economy towards greater heights. And all the policies formation, all the capex that is driven by the government is what really leads to that path in terms of decades ahead. And our government also is very supportive of that ecosystem for growth. So I think this is one of the key reasons why our path also will be quite progressive over the next decade or so. The third is when you look at equity participation. Now, this is a important aspect because a lot of the companies and there is a lot of capital starvation, credit starvation, which is there in the economy. And if you have a very, very healthy capital markets, what that helps you is in fact, raising of capital, which in turn leads to a lot of these capacity creations and in turn a lot of the demand acceleration as well. So equity participation also for any country is very important. Having a healthy capital markets and equities is important for that growth journey in the next decade, 2 or 3 to come. The fourth aspect is the infrastructure push. Now, any economy that is growing needs infrastructure to collaborate and to have a supportive ecosystem for that matter. In this aspect also, India is doing quite well, and our government, it's majorly led by the government at this point, but the private sector is also starting to add on to it. So that aspect is also leading to a very key tailwind for the economy overall over the next decade. Then you come, we are the fifth largest economy as of today, and we are going to become the third largest economy. And when you reach those heights, you start getting more recognized globally. And there are a lot of such contracts by companies that are won once you become large, which you were not eligible for before. So those kind of things also start coming into picture. So once you become that third largest economy, you get a lot of new access also, which you were devoid of before. For example, you have global bond indexes, which are India is now being included as part of. So that capital flows through as well. And the last aspect is the consumption. So today, given our per capita where we are, historically, when we look at US, China, and across the geographies, this per capita level has always been an inflection point in terms of consumption growth. And for India also, there's no reason why it should be any different. So that is also key reason why India's next decade or so will be very, very strong. And it's like a Goldilocks as of this time because all of these aspects are in consensus going towards that growth progress, and none of the issues are there which we can really call out that these are the big risks in any of these aspects. So all of these aspects are turning out to be quite favorable and turning out to be quite a tailwind for India over the next decade, which was not so maybe 10 years back. A lot of these aspects may not have been that much of a tailwind, but a headwind for that matter, like macro stability. Our balance sheets were not that strong 10 years back compared to what it is today. So as of today, all these aspects are uh, contributing to our journey in the next decade. So that is why the India's next decade is going to be extremely strong compared to what we have seen. Now, coming to each aspect, now when you look at macro stability, as I mentioned, you look at the fiscal deficit. Now, fiscal deficit, obviously, COVID times, you had increased it to support the economy and the lowest sections of the society. However, now, given that things have now normalized, you are seeing the deficit number also coming much in line with what is our comfortable levels. The other aspect, when you look at our inflation numbers also, despite we being one of the fastest growing for that matter in the major economies, our inflation has remained far to in a comfort zone where we want them to be. But the core inflation, if you look at it, has remained much more stable compared to the CPI headline that you see, because of the food inflation has maybe been a bit more volatile, but the core has been quite steady for us. So both these aspects are lending a great amount of stability to the macros, which is helping us in a big manner over the next decade. The other structural improvement that is happening is on the current account side, wherein now we are starting to move into a zone where current account is becoming much more neutralish compared to what it used to be. And there is a decent amount of services exports which are leading to this. But broadly, our trade is picking up quite well, and which is leading to a much better trade surplus or current account for us overall, which is a very, very key thing when you look at the next 10 years, 20 years. Unless you have this in control, it becomes a challenge to grow beyond a point. So the journey, basically from a GDP perspective, which has been the measure historically for every economy, is you are looking at when you were 10 years back, you were ninth ranked, and you are moving towards the fifth rank, and next 2028 or so, 4 years down the line, you are very well poised to become the third largest economy. Now these are just conservative estimates. I think we can become even faster, but at this point in time, just 2028, you are poised to become the third largest economy. So imagine the another 10 years down the line, how well you are poised over the other geographies. Now, when you look at broadly in the last 20 years, as we talked about, you have seen our GDP rank go from 13 to 5, our share in the world GDP going from 1.4 to 3.4. That is only going to improve because you have a population base which is 15-20% of the global, and you have a GDP contribution of 3.5. At some point, some convergence has to happen. So we cannot remain at 3.5% of world GDP, so to say. Even as a part of emerging markets, our contribution is only increasing. If you remove China as part of the GDP, you will look at that our contribution of ex-China GDP is only improving. Now, the benefit of this improvement in your is again on the fact that your index weights and everything increases globally, which leads to more money flow coming in. Now, when you look at India and its journey, you are always tempted to compare it with US and China, which has seen a similar journey because their demographic dividend in 2000s and the 1980s used to be similar. So when we compare it with US, let's say US was at the level that we are in terms of GDP, where it was in 1980 and what we are today in that sense. So US has seen a journey from 1980s to today, where its GDP has grown from 3 trillions to now 28 or 28, 30 trillion dollars, and it has seen that journey through. In that journey, equities has also done well. Similarly, it has always been a multiplier of whatever the GDP growth has been in that period. Similarly, you see China was 2006 at the point where what we are today, and the journey it has seen from them has been exceptional. So we are going to see a similar journey. There's no reason why we would not be seeing a similar journey as to what US and China has seen. Now, when you look at them, the better part of this is that you know about the mistakes that US and China has done. So you know that US had a lot of these tech bubbles and the GFC which they faced. Compared to that, we may be much more smoother in our journey compared to what US has been. Even China, for that matter, has seen a property crisis, and there's a lot of other issues which China has had. We will be far more calibrated in our policies when we are incentivizing our industry. So when you look at PLI and you look at other government policies, you will see that there is a learning from the mistakes that a lot of the other geographies have made in their policy formulations, which we have tried to avoid. So at least the same mistakes you will not be making in that manner, our journey will be far smoother than what you have seen in other geographies, because you have people who have learned from the mistakes of the other geographies, but you will have a similar growth that they have seen. So something like a China in 2006, we are today. 1980s of US, we are today. So imagine the kind of decadal opportunity that you have in front of you, and no matter what market levels or you see, if the GDP grows, you will have a multiplier impact on your market cap as well. There's no reason why it should not be the case. So one should never be worried about the decadal opportunities that India throws at you, compared when you look at what US and China and other geographies have seen. Now, when you look at it, let's start with the government's initiatives, basically, which are leading to the growth. And government has been a key pillar in terms of the implementation of these policies in the last 10 years or so, which has been far, far more focused onto industries and taking care of all the pain that they have seen over the past years. When you look at the production PLI schemes, the schemes are across the sectors, getting as minute as you can to make sure that you are incentivizing every state of the value chain of the products. And in terms of that, also they have tweaked the policies for, in terms of the sectors they are aligned to, and accordingly they have come out with policies wherein you are not just incentivized to put up capacities, but you also have to think about the demand and everything, because there are also sales linked in that sense. So the production linked incentives is something which is going to give you fruits over the next 10 years, 20 years. It may not seem like a big fruit in next 1 year, 2 year, but when you think about a little long term, these type of incentive schemes are something that shapes up the next 10 years, 20 years in any economy for that matter. Similarly, government's focus towards the infrastructure development has been so high in the last 10 years. You have seen a massive amount of capex that have gone into highways, to railways, to defense, ports. So all of those areas have been developed, and those areas are always needed so that there is a capacity when actual demand comes in. So you have to take care of the supply side first and make sure that when the demand pours in, be it from exports or be it from domestic, you have the infrastructure in place to cater to that demand. And that's what we have done in the last 10 years to make sure we have those infrastructure in place. We still need a lot more infrastructure going ahead. I think next 10 years, 20 years, this story is also not going to die down that easily. Now, when you look at GST implementation, given that India was so vast and you had so many of taxes, VATs, mod VATs, NVATs, getting them together and getting a more simplified process is what GST has done. And that is something, again, is something which will give you fruits over the next 10 years, 20 years. Now, the other aspect is the entrepreneurial culture. I'm sure everyone knows about the kind of startups that have come up in India in the last 10 years. Now, that kind of risk taking is very much required when you're thinking about 10 years, 20 years. And that is something that India is also moving towards. Power sector has always been a big problem for India historically, wherein we have always underestimated at some point, overestimated at other points, and we were always short of power, so to say. Even today, we are short of power. So those reforms have also now started to take place. They were taking place, now they are accelerated even more, which will help us having a good energy availability for our growth, so to say. Because if you are going to grow, you need electricity, you need energy to support that. And then there are other reforms like RERA, UPI, Jandhan. All of these reforms, the last 10 years has been a complete uh, blaster of reforms that we have done in the economy. And these benefits, you may see that short term, you're not seeing any benefit of them. But when you look at it from a 10-year, 20-year perspective, you will realize that these measures is what really creates the difference. Like we saw during liberalization, 30 years down the line, you realize that your GDP is 10x, 15x. So that's the kind of change that these reforms bring in. So broadly, as was mentioned, that you are at an inflection point in your per capita GDP, wherein a lot of consumption starts to take place because the basket that India consumes, because that basket changes and that basket moves more towards discretionary spending. So as your necessities are taken care of and you start to have additional income, additional disposable income, you start to have aspirations as well. And you start to look for comfort and everything. And that's where a very big inflection point in the GDP that comes through. As you can see, already we are seeing that the necessity basket is already coming down quite a lot. And it is only going to come down because our per capita GDP is only going to go up. In front of that, you will see a lot of these aspirational discretionary basket which is going to go up. Now, which is a very big positive for the consumption side of the economy, because these consumption baskets are something which drive high margins for the companies and also are much more sustainable in that manner. So for that reason, the per capita GDP growing and we reaching an inflection point is a very, very key imperative growth paradigm for the next 10 years, 20 years that we are going to see. Other aspect, when you look at manufacturing, that has been one of the most focus areas for the government in the last 10, 15 years. And then in that, our share on GDP, we have always not been doing quite well over the previous cycles. In that, because of the PLI incentives and because of a lot of other things, what we are expecting is that the contribution is going to go up significantly. And that is where you will see a lot of growth drivers happening over the next 10, 15 years. Because our manufacturing capacity going up is a very big signal, because that leads to a big multiplier impact over the next 10 years. And it happens across consumption, it happens capex wise, exports wise. So all the brackets of the economy does well when you are getting a manufacturing going for you. When you look at the global manufacturing also, and this theme has been there, a lot of people have talked about China plus one because everyone wants to de-link to some extent from China. In that aspect also, we bring in a much more competitive market, so to say. We are still much smaller than what we should have been. Our potential is, we are still at 2.9% or so. But that is something, again, a big growth driver for us over the next 10, 20 years. So that's where our exports market is going to be a big driver. And because of the PLIs and a lot of other initiatives that are coming in, you can see India product exports also doing well. Services exports, we are doing well. But product exports also, we can start to look at as a growth driver for the economy over the next 2-3 decades. So boiling in, when you look at the capex also, the center has actually been the force behind capex, and government has given a big focus towards it. You have seen that number going to 11 lakh crores in the last budget that they presented, and you have seen those numbers were at 4-5 lakh crores before. So you can see the kind of growth that has come through because of that. And because government's focus is to that extent, that number is only going to grow even going ahead as well. So India's GFCF is going to go much higher, and at some point the private also will be incrementally adding to it in that manner. And so any economy which does capex in this manner, I'm sure you know that whenever companies put in capex, when they put in that capex, growth capex, so to say, you see growth coming in from the next year, and that remains for the next 10, 15 years. So that's the journey India is in terms of its capex policies and the growth that we are seeing in that. And the fruits of this increase, you are going to witness over the next 10, 15 years. And that is why the journey is going to be much better than what it was in the previous 10, 15 years. Now, this is, as I mentioned, the equity participation of the market. The number of people who are now part of the equity markets and the capital markets overall has gone up significantly. Now, I know there is some bit of speculation which is there, but if what happens is that there is speculation, but over time those investors become mature. And as they become mature, they understand the markets much better, and they understand which companies are doing much better over cycles. And then the money starts moving into much better companies, much better sectors as they mature as well. So even though this journey has just started, I think this journey is still a lot of legs to go. And the investors also will become much more mature in the next 5-10 years. That's going to lead to much more capital availability for the companies that are looking to grow, and that entrepreneurship will increase going ahead. And that's what will lead to the growth over the next decade. Now, historically also, if you see, not just I'm talking about future more, but historically also, if you see, India's growth has always outperformed the global growth. So this is pretty much shows you on an average we have pretty much outperformed 2-3% compared to what global has been growing. I would like to believe our potential is far higher than what even the 2-3% that you're seeing, but at least that much it should be. So there should not be any doubt in your mind that when we stand 10 years down the line, we will be still growing much faster than the world. Our share in GDP, as I showed, will be far higher than what it is today. Our share in manufacturing also will be far higher. Our consumption base will be far greater in the next 10 years. So what has happened in the previous 10 years will happen in the next 10 years also. But the next 10 years will be far better because of the initiatives and everything that I showed you right now. Now, India gets compared to the emerging markets obviously a lot, and that's what we also, as a foreign investor, also would be comparing in that manner. So when you look at China, you look at Taiwan, you look at South Korea, you look at Brazil and all, our weight in the index is now 19%. It was far lower before, but now we are 19% in the EM index, so to say. But normally, whenever you compare geographies, you're comparing them on growth, you're comparing them on export dependence, you're comparing them on how commodity dependent they are, and what is the geopolitics that the country has. In all the parameters, when you look at them, apart from maybe export, where we are still in a journey to increase our exports, across the parameters, we rank far higher than what our peers in the emerging markets are. So we are an attractive destination from every aspect, if you see. So no matter you take it on the domestic growth, we are growing faster than every other economy. You take it commodity dependence, we are far lower in that sense because crude going up or down will create an impact on your current account and you will create an impact on your oil imports. But it's not that your GDP will take a big hit compared to what others will be seeing. Geopolitics wise, we have become a soft power pretty much now with good relations with across geographies. So even if in the war situation that you're seeing today, India is far better placed than compared to other nations. So geopolitically also we are far better than what other nations in this category at least is. So that tells you that India in the emerging market also is far better. So the journey that you saw in our contribution going in ex-China emerging market from 40% to 47% is only going to get higher. It is not going to get lower. So, and that is a trend for the next 10 years, 20 years, which you have to be a part of. One key issue headwind that used to be the case for India last 10, 15 years was that the states which were doing well continue to do well and were giving the biggest growth driver to the GDP of India. Like for example, Maharashtra, Gujarat, Tamil Nadu, Karnataka, all these states were doing much better and they continue to do much better. However, there were certain states like UP, Bihar, which were facing challenges, which has great amount of demography and everything, but they are facing a lot of challenges. Going ahead, what we believe is that those states also will start contributing to your growth in the country. And once that happens, you are going to see a much more collaborated and much more sustainable growth over the next 10, 20 years. And that is the reason I'm saying that the states which were not contributing will start contributing, and the states which were doing well will continue to do well. So you will see a much better growth rate going ahead compared to what we have seen. Now coming to just in terms of the markets and the fund that I manage. So my fund is a large and mid cap fund, which basically the category forms 82% of the total market cap that we have. But with the small cap into that fund as well, we pretty much cover the whole spectrum of the market. So our fund today covers pretty much the 100% of the market, but as a category, it covers 82% of the total market cap that you have. So it's one of the most diversified funds. And when you look at the journey that India is going to see, the diversified fund will take care of all the aspects of the economy, so to say. Now, compared to the large cap indexes, the smaller, the large and mid 250, which is the large and mid cap index, there you get exposures into sectors which are doing exceptionally well. For example, capital goods, consumer services, real estate. Those are the sectors which have done well in the last 5 years, in the last 2, 3 years. And those are the sectors where you're seeing a lot more growth opportunity compared to the larger sectors. And compared to the large caps where you have far more concentration of financials, IT, oil and gas, Compared to that, in the large and mid, the concentration is far lower, and you have a much more broad-based in terms of its exposure, so to say. So coming to the fund that I manage, which is the Bandhan Core Equity Fund. It is one of our flagship funds, which is the large and mid-cap fund. And the philosophy that we follow in this fund is of a DAM framework that I have put in. Is basically, when you see DAM, the D part stands for dynamism, which basically tells you is that the portfolio will be dynamic in approach and we will be very an active fund manager, because the right now what is happening is that the value in the market is moving very fast. So at some point, 10 years back, 20 years back, certain sectors used to do well. They used to do well for a long period of time, and there was no disruption in those sectors. Currently, what is happening is a lot of sectors are seeing churn in their outperformance over a month, also over 3 months, 6 months as well. So you have to be dynamic in identifying those outperformance timelines, and you don't want to be stuck with them when they are underperforming. So that's why our philosophy is we will be a dynamic fund manager, and we will going to manage the fund with those idea in place that we are going to churn it as and where we see that value, fair valuations reaching for that matter. The second aspect is the anti-fragility part of it. Here, the idea is the number of stocks and the sectors that we will have, the spread that we'll have in the fund will be far higher than what is there in the index or the peers, for so to say. Because we believe that once you, given the market where it is today and a broad-based market, how it is, you have to be spread out to get the maximum out of it. Concentrated approaches may work out in some periods of time. At this time, we believe because it's a broad market rally and because there is disruption in a lot of sectors, the winners and the leaders of yesterday may not be the leaders of tomorrow, is the thought process that I have. And you have to be very dynamic in understanding that and being part of the whole chain to know where the value is moving in. So that's why you have to be anti-fragile. So because your portfolio should not be fragile to one key event or one key company or a sector not doing well. So that's why the number of stocks also may be higher compared to my peers, so to say. The third aspect is the macros, and we believe that today in the market that we are in, if you don't have a belief, if you don't have an understanding of the macros of the market, both global, domestic, then it will become a big challenge for you to create a portfolio, because there are far bigger trends that are playing out in terms of global macros, which you have to understand and be a part of. Otherwise, you may miss out on a lot of opportunities going ahead. Taking that philosophy into perspective, how I construct my portfolio is basically I divide the market into 3 buckets. There's nothing beyond these buckets in the market. So the bucket is basically the high growth, quality, the optional, and the value, and the thematic cyclicals basket. And this is a 360-degree approach that we take to return generation in the fund. The idea is that the fund should not be any style biased. So we are trying to create a fund wherein there is no style bias. And at any point in time, if the market is moving from a growth to value to thematics, we should move accordingly. And at any point in time, I should know that my fund has what exposure in which bucket. And accordingly, I should be wary of where the outperformance is coming from. So over time, what happens is as people, you also have your biases and you also make your money in certain style that you like. Over time, you start becoming biased towards that style. We have put in the process in place, and this is what is monitored monthly basis, that we make sure that there is no style bias. At any point in time, if growth becomes way too high in my portfolio, I start evaluating value and thematics much more compared to what I was evaluating a month or two back, which leads to me getting much more idea generation, so to say. So this approach, I believe, has what helped us in the last 1 year in the alphas that we have generated in the fund. And even going ahead on a more sustainable basis, I think this approach is the right approach to go ahead. This is broadly how, as I mentioned, the churn and the changes that we have done in the portfolio. So you can see that the large cap and the mid cap and the small cap contribution, how it has tinkered over the different months. And we have been quite active in changing according to where we believe the market is moving in. This is broadly our portfolio, top holdings in our portfolio at this point in time, as of June end, so to say. And this is how the churn has been within the market caps. So the category, basically, you cannot go below 35% large cap and 35% mid cap. That's what is maintained. Other than that, we don't really maintain any limits. In small caps, I have a limit. I don't go beyond 20% in small caps. But in the large and mid cap, other than the category limit, there's no other limit that we have put in place. This has been the last 1 year performance for us in the fund, the alpha generation that has come through in the last 1 year. Yeah, thank you.
Yeah, so thank you, Rahul. Thank you for sharing such a great insight. So participants, forum is open for Q&A. So if you have any question, please write it in the chat box. We'll take the question from there. So we already have some questions, Rahul. So I'll take one by one. So one of the participant is asking like, what could be the impact of US recession in Indian market and how big would be the threat is?
Yeah, so see, US recession again is something, and when you look at the large caps for that matter, there's a reason why large caps have not done as well as these small caps, so to say. Because small caps, when you look at them, they are more tuned towards domestic growth stories. However, when you look at large caps, therein the amount of global exposures are far higher. Like for example, IT companies, you have these auto companies which are there. There the global exposures are higher. US being the largest consumer of the world, that creates an impact on India as well. So US recession, just from a market cap perspective, I think will be good for small caps because that's the focus area will increase because large caps will continue to underperform in that period because if US is not doing well, the larger parts of the large cap may not do well in that manner. The other aspect to look at it is that if US goes into a recession, how does the liquidity changes in US, so to say? So then liquidity moves out of US and starts looking for growth areas across the world. So then emerging markets may see an inflow in that matter. But again, that would be again dependent on how Fed reacts to that recession, so to say. But just from a recession perspective, if that comes through, I believe small caps will keep outperforming large caps if that is the case that comes through. And certain sectors of India will underperform in a big manner then over the next 2-3 years or so to say. That is just the broad lay of if US recession comes through.
Okay, then another thing is like we have seen many thematic funds who did well, and you already discussed about it, but for the benefit of participants, so I'm asking this question. So like we have seen a good return in those themes. So how those themes will be included in Bandhan Core Equity Fund, and how frequently we are changing from one theme to like whatever themes which are looking lucrative, so we are participating there.
So when you look at our fund, and this is we have been playing last 1 year, the performance that you have seen has been on back of couple of themes that we have played right. And one of them was power sector. As I mentioned, that I have been exceptionally positive on power reforms and the power shortage that has been there. So because of that, there are certain sections of the market which will continue to do well. And even going ahead, I believe those will continue to do well. The other theme which we captured well and which we has led to our performance is the real estate theme. And again, there also there's a change in the cycle which has happened, and that turnaround may continue for some time. We may not be at the late stage of the cycle. We believe we are more in the middle stage of the cycle. So there also you can see more growth coming through. Other than that, you have certain specific areas, uh, like in some of the internet companies which are there, which are doing well, along with some of the pharma. In the US side, the generics are seeing a cycle again going in their favor. So those are the specific themes that the fund keeps investing in. So last 1 year, you would have seen that going through. So at any point in time, there are certain 2, 3 themes, 4 themes which I am positive on, and I increase my allocation in the fund accordingly. But at the same time, I make sure the anti-fragile aspect, which I mentioned, because I
Yeah.
make sure that whenever you look at my fund and the returns that I have generated, the confidence that should come to you is that this performance is not on back of one theme playing out. And when that theme dies down, the fund will die down. Because that's what happens with most of the funds. Because when that theme does well, that fund does well. Other times it doesn't do well. So our idea in the fund is very clear because we want to be as anti-fragile as possible. No one theme or one sector or one stock is going to lead to very, very disproportionate returns in that manner. So even if you look at my last 1 year return and you break it down between sectors which has given that returns, you will realize that that return has come from 20 different sectors, 17 different sectors. And you will realize there are only few sectors which have been detractors. So that's where the difference is, that we play themes according to whatever we believe is the right theme at this point in time. But at the same time, we don't just play that theme, and we are clear in the sense that we want to diversify as well, but play those themes as well. Now, the question on thematic funds and all that is, see, I have a belief that India's investors are getting much, much more mature compared to what they used to be. And you have seen that election day, the kind of inflows that you have seen from retail and the other participants has been a proponent of that as well. People are getting much, much more mature, looking at next 5 year, 10 years, and then invest in that manner. Now, when that happens, whenever maturity comes in any investor, they start to look for more focused area according to what they like. So if today I understand the markets, I understand what is happening in the economy, and I become mature enough, then I would like to have some thematics in the areas that I like. So for example, if I like defense, I would like to have some thematic exposure on defense. If I like manufacturing, I would like some on those front. So on those areas, then investors starts to look for. So for me, that is actually a very big positive, because I know my investors are getting mature, and whatever they were doing in the past. So the biggest thing is how much time they were churning their mutual fund portfolios. I believe in the next 5 year, 10 year, that horizon is going to increase. So for example, if they were churning it in 3 years, average holding period of any mutual fund, that number is going to increase. So that's the investor maturity that comes in. And when they do that, me as a fund manager also, I get the leeway to look at companies more from a 3 year, 5 year, 7 year perspective, because my investors are also now looking at it in that manner. And that's when you get a good alpha. You start getting much more alpha in that sense. So thematics is actually a good inflection point, I believe, which shows us that investors are getting mature and understanding the risks behind these thematic funds. And they're starting to put their money in that, taking those kind of risks as well.
Okay. Yeah. So another question is like when we are talking about and when we are seeing like market is all-time high, wherein Sensex is around 80,500, Nifty is around 24,500. So in this case, wherein like how cautious the investor should be.
So I see there are certain things that have happened, the election, and there are a lot of other events like the Fed rate cut that we were expecting in the start of the year, which has not panned out. So next 6 months or so, when I am talking about, and this is more short term in that manner, there are certain key events that you need to watch out for that. Like the budget is one of the key events that you are going to watch out as an investor. And also the Fed rate cut in September. There are two rate cuts expected by this year and now. So those also you are going to watch out in a keen manner. So my suggestion would be that when you are investing, if you, as I showed you, that India's journey over the next 5 year, 10 year doesn't change. The valuations may look expensive as of now. So we also have a kind of a tactical caution in that sense. We are also cautiously optimistic, in so to say. Uh, so near term, the kind of returns that you have seen in the last 1 2 years have been quite high, and that's where somewhat of a moderation may come through, but that doesn't really change the journey that we are on. And that's what I showed you, that the journey you should look at it in 5 years, 10 years frame, and not just in the next 6 months frame. But if somebody is looking at it in 6 months frame, there are a lot of events that can change the course of market in some one way or the other. Those events like budget I mentioned, the Fed rate cut I mentioned. So those are the events that you are watching out as a risk to the markets. However, liquidity has been extremely strong. So that is the positive of the market. The price momentum has been strong, liquidity has been strong. So there are both the forces which are working for the short term. However, I'll still recommend that when you look at even today, and with a thought process that you're going to keep for next 3 year, 5 year, 10 years, I don't see the market is anywhere near to its potential over the next 5 years or so to say. There are some bit of that time correction or so can happen, because the kind of returns you have made in the last 1 2 years is very healthy. But that doesn't change the course we are on in any way. So some bit of time correction is possible in the short term, but I wouldn't look at it as a big correction opportunity, so to say, that one should wait for and then put in the markets. That's not my thought process as of now.
Okay. Yeah, understood. So another question by another participant is like, we have seen growth in mid cap and small cap companies, a good growth we have seen. What should be the expectation which investor should keep in these sectors like small cap and mid cap?
See, broadly, what happens is that you should have an expectation about the GDP of India, right? So GDP is going to be 3x, 4x over next, let's say, 7, 8 years, 10 years or so. So you are going to grow in that manner. 10 years, let's say you have that view. In that view, the market will grow at a percentage 1x, 1.2x or 1.1x, 1.4x. US that has happened, China that has happened, right? Now, in that period, when you look at it, small caps, because I have a belief that India, incrementally the entrepreneurial culture is going up, and there are a lot of more companies which are disrupting. And large companies cannot disrupt in that manner. Small companies disrupt far more because they don't have those hang-ups of their cash cows, so to say. So small companies can do those disruptions, and that's where the big alpha always gets created. So I believe mid and small, even from a more longer, even from this here on, I believe next 5 year, 10 year, that's the area that is going to be in focus. And if whatever the view you have that we are going to become the third largest economy, and accordingly the GDP growth, let's say, will be in the range of nominal GDP growth will be in the range of 12, 13% or so, the CAGR that you get. In that CAGR, you add a multiplier to get your small cap, mid cap returns, the market cap returns. And that's something you should keep expecting over the longer period of time. I don't see a challenge in that. Last 1, 2 years, we have got exceptional return again. You may see some bit of moderation in the next 1, 2 years, 1 years or so. But beyond that, our ROE profiles of small cap companies are getting much better. Their growth aspirations are getting better. Their capex are getting better. So from every aspect, when I look at them and the balance sheets that they have, the cash flow generation that they have as a class altogether is getting much better. So even from here, my view over the next 5, 7 years, I am medium term, I am positive on mid and small even from here, comparatively what they have done. Large caps may do well, but I think mid and small will continue to do well even from here. But you need to have a bit more longer horizon at this point in time because you've seen much exceptional returns in the last 1, 2 years, which cannot return every year. So your expectations have to get right. And if you believe that GDP is growing at X, your expectations should be 1 point something X. It should not be 2, 3X of that. That's not what you should have in your mind as investors when you're investing in it.
Yeah, great. Uh, so another question from another investor is like, there are many passive funds, there are many index funds in the market. So how the active funds are like beating those index fund?
So actually, so there are cycles, right? There are times when passives have done better, and there are times when active is doing better. At this point in time, active is doing far better than what passive is doing. I think you can see the last 1 year also, the alpha that I have generated is 10% plus, right? So this is a period when active is doing much better, and that can continue for some time, I believe, because the market is much more broad-based, and there are a lot of events which are creating those impacts. So whenever mid and small, the market is broad-based, those times active management is where you get those big alphas, so to say. So I think this can continue going on for some time. And when you're in a growth journey, the way our country is, I believe that journey, active management captures far better than passive management, so to say. When you become mature, there's nothing much to do, not much disruption happening. That's when passive may do a bit better because there may not be a lot more growth opportunities. But when you're in that growth phase, like India is for the next 50 years, 40 years, active management is where you will get those alphas going for you. Last 1, 2 years has already shown that the amount of alpha created by active fund managers like me has been far more than what you would have got in your just index tracking, so to say.
Great. So Rahul, I believe we have covered all the questions. So thank you for answering all the questions. And I request all the participants to kindly get in touch with relationship manager, wherein if you'll be required further detail on this particular scheme or any other scheme, they'll definitely help you for the same. So thank you, Rahul, and thank you everyone for attending this webinar.
Thanks, Diwakar, and thank you.